They actually went through with it. And while most people had no idea, the rules governing silver ownership in America just changed forever. You weren't watching this. Nobody was. While cable news recycled the same arguments and financial media obsessed over the Fed's latest whisper about borrowing costs, a regulation moved quietly through the machinery of government, one with direct consequences for every single person who holds physical silver. It passed. It was signed. It is now law. And it takes effect February 15th. Not eventually, not hypothetically, February 15th, weeks from now. What exactly changed? Who does it affect? And what does it mean for the way you buy, sell, and hold the metal you've worked hard to accumulate? That's precisely what we're going to break down today, in plain language, with real numbers, and without the noise. My name is not Warren Buffett. I'm the host of Mind Over Market, and I've spent the last 3 days deep inside the regulatory language, the dealer guidance, the compliance frameworks, and the attorney commentary that explains what this new rule actually demands. I want to tell you up front, what I found is more significant than the few headlines that bothered to cover it. The thresholds are lower than most people assumed. The data collection is more invasive than the industry expected, and the penalties attached to non-compliance are serious enough to reshape how every serious silver holder operates going forward. Let me be direct. The government is not knocking on your door to take your silver. But they are, right now, building the infrastructure that records who owns it, how much they bought, and how they paid. They are erecting the reporting architecture that ties your name, your address, and your federal identification number to your precious metals activity. This is not speculation. This is not forum chatter. This is published federal regulation, entered into the Federal Register with an enforcement date attached. The database is being built whether you know about it or not, whether you prepare or not, whether you agree with it or not.
The only question that matters now is whether you understand what this means for your stack, and whether you act accordingly before the deadline arrives. Today, on Mind Over Market, we're going to walk through what the new rule requires, who gets captured inside it, what information flows to the government, and where it goes from there, what the penalty structure looks like for violations, and what you can realistically do right now to protect your position legally. This may genuinely be one of the most consequential conversations we've ever had for precious metals holders, and the clock is not pausing for anyone. Let's start with the foundation. Where did this come from? The new reporting requirements trace their origins to the Anti-Money Laundering Act of 2020. A piece of legislation that significantly expanded Treasury's authority to push compliance obligations across financial sectors, including sectors that historically operated with considerably more privacy than banking. Precious metals dealers have been on the regulatory watch list for years, intermittently, without urgency, because volume was manageable and political will was inconsistent. That calculus shifted. The rule was formally published in the Federal Register on January 10th. 35 days later, February 15th, it takes effect. That calendar math is not an accident. That gap is intentional. It is short enough that most affected parties don't have time to mount significant opposition. It is long enough that regulators can claim adequate notice was provided. So what does the rule actually require? Let's get into the specifics because the details are where people either protect themselves or get blindsided. Precious metals dealers, defined as businesses engaged in buying, selling, or exchanging gold, silver, platinum, or palladium products, are now required to file currency transaction reports for cash purchases that meet or exceed a specific dollar threshold. That threshold is $3,000. Read that number again, $3,000. Most people who've followed financial reporting rules over the years are familiar with $10,000, the standard bank-level CTR threshold that's been part of American financial life for decades. Precious metals are now being treated as a separate and more closely monitored category. The effective tripwire is $3,000. At current silver prices, using approximately $75 per ounce as a reference point, $3,000 buys roughly 40 ounces of silver. That is not a whale buy. That is not someone moving extraordinary wealth into hard assets. That is a normal, moderate purchase for anyone who takes silver seriously as a component of their financial preparation. Think about what 40 ounces looks like in practice. A single monster box of American Silver Eagles contains 500 coins and runs $40,000 to $45,000, depending on current premiums and dealer margins. Under the new reporting framework, virtually any cash purchase of meaningful size now triggers a federal report. We're not talking about bulk buyers moving tens of thousands through the market. We're talking about serious but everyday stackers making purchases they've been making for years. Purchases that, starting February 15th, create a documented federal record. But the CTR requirement is only the first layer. The second layer is where things get considerably more complicated and considerably more dangerous for people who don't understand what they're walking into. The updated guidance also expands suspicious activity report expectations for precious metals dealers. SAR filing is the mechanism through which financial businesses flag behavior that appears designed to evade reporting thresholds. The rule directs dealers to file SARs when they observe transactions, or patterns of transactions, that suggest a customer may be intentionally structuring activity to stay beneath reporting levels. Here is the scenario that gets ordinary people into serious federal trouble. You purchase $2,900 in silver on a Monday. You come back Tuesday with another $2,900. You were not trying to launder money. You were not evading taxes. You simply had more cash available the second day, or you wanted to spread the purchase. In your mind, two separate buys. In the regulatory framework, your dealer is now required to operate inside. That pattern can constitute structuring, also referred to as smurfing. And structuring is a federal criminal offense, regardless of the underlying intent behind the purchases. Penalties for structuring include up to 5 years in federal prison. Financial penalties can reach $250,000. And the element that makes this especially dangerous is that you do not need to have actually been doing anything wrong for the report to be filed and for your exposure to begin. The standard in many cases is the appearance of evasion, the pattern, not the proven intent. Once that suspicious activity report exists, your invisibility is gone. Your name is in the system, and the door is open for further scrutiny. What exactly does the government collect when a currency transaction report is filed? This is the part that should concern anyone who values financial privacy. A standard CTR contains your full legal name, your date of birth, your social security number, your home address, your phone number, your stated occupation, the dollar amount of the transaction, and descriptive details about what was purchased and how. That package of information travels electronically to FinCEN, the Financial Crimes Enforcement Network, which is a bureau of the United States Treasury Department. From there,
The data sits in federal databases accessible to agencies with appropriate authorization, which includes the Internal Revenue Service and various law enforcement bodies at federal and state levels. What that means in practice: a cash purchase of approximately 40 ounces of silver now generates a federal record that documents your identity, your location, and the exact nature of your transaction. Every time that happens, that record exists. It doesn't expire. It doesn't disappear. And it can be retrieved whenever a future decision is made to use it.
The reporting infrastructure is only half the picture. The second major shift embedded in the new framework involves customer due diligence standards and beneficial ownership identification practices. Starting February 15th, dealers are expected to implement formal customer identification programs modeled after banking compliance structures. In practical terms, what does that mean for a buyer walking into a coin shop or placing an order with an online dealer? Before completing a purchase at or above the threshold, you may be required to present government-issued identification, provide your Social Security number, and submit to identity verification. And here's the detail you need to understand before you assume this only applies at the exact threshold. Dealer behavior is already running ahead of the written minimum requirements. Multiple dealers preparing for February 15th compliance are implementing identity verification for purchases above $1,000, regardless of payment method, simply to create distance between their operations and regulatory scrutiny. The world you knew before, cash in hand, silver out the door, no record, is narrowing fast, and February 15th is the formal closing of that window. Now, let's talk about private sales, because that's where a lot of silver holders assume they still have significant protection. The current regulatory language targets businesses engaged in precious metals trade. Person-to-person private sales are not directly captured inside the new dealer reporting requirements. That's the good news. The important caveat is that tax law never changed and doesn't need this new framework to apply. If you sell silver for more than you paid, the gain is taxable. Capital gains on silver held longer than 1 year can be taxed as collectible income at rates up to 28% at the federal level, plus applicable state taxes. That obligation exists independently of any dealer filing a report. What the new reporting environment changes is not the existence of that tax obligation. It's the visibility of your activity. If federal databases now capture your purchasing history in detail and your tax filings don't reflect corresponding sales of gains, the discrepancy becomes considerably easier to identify and investigate. The database is not just about the present transaction. It's about the future conversation that becomes possible once the data exists. The database isn't the tax. It's the map they use to find the tax later. Why is this happening now? What's the driving logic behind a regulatory push of this scale at this particular moment? 3 factors converged, and understanding each one tells you something important about where this is heading. First, precious metals demand exploded over the past several years. New buyers flooded the market. Transaction volume climbed significantly. More value started moving through an asset class that historically operated with more privacy than any bank account. When money flows at scale through a low-visibility space, regulators eventually follow. The sheer growth of the market moved it onto the priority list. Second, anti-money laundering enforcement has become an aggressive priority across the entire financial sector. Treasury has systematically expanded compliance expectations into industries that were previously operating on lighter frameworks. Precious metals dealers have long carried a perception, fair or not, of being potential AML risk points because of cash transaction prevalence and the portability of value.
That perception drives regulatory attention regardless of actual documented abuse. Third, and this is the factor that doesn't get enough attention, the fiscal position of the federal government is under extraordinary stress. Deficits measured in trillions, national debt accumulating at historic pace, interest costs consuming larger portions of the federal budget every quarter. When a government is under that kind of financial pressure, two things happen reliably. It looks for revenue, and it looks for control over assets that exist outside its easy reach. Physical silver is exactly that kind of asset. You can't inflate it away. You can't freeze it with a single administrative command the way a bank account can be frozen. It holds value independent of the dollar's purchasing power. It can be held quietly, transferred privately, and sold without a digital footprint. Or at least, it could be until now. The new regulatory architecture is designed to bring precious metals into the same visibility framework that governs banking and tracked financial activity. The privacy that made physical metals attractive to certain holders is precisely what made them a target for this kind of regulatory attention. I want to be precise about something because the line between analysis and alarmism matters. This rule is not confiscation.
There is no government agent coming to collect your stack, but it is the construction of preconditions. History offers a clear and documented reference point. In 1933, an executive order compelled Americans to surrender their gold holdings to the Federal Reserve. I am not predicting a repeat of that event tomorrow or next year. I am pointing out that databases get built before they're used. Infrastructure gets constructed before policy deploys it. The preconditions for enforcement capability exist before enforcement decisions are made. Understanding that sequence is not paranoia, it's pattern recognition. Now let's talk about how the dealer community is actually responding to this, because the ground-level reaction tells you something about the real-world impact beyond the language of the rule itself. Large, established online dealers are moving into full compliance mode. They're hiring staff with AML backgrounds, building automated CTR and SAR generation systems, updating customer databases, and preparing to collect significantly more information from buyers. They're doing this not because they love it, but because they are visible, traceable, and large enough to be regulatory targets if they don't. For these dealers, compliance is survival. Smaller local coin shops are facing a genuinely brutal calculation. Compliance costs real money: training, systems, legal review, ongoing record-keeping. For operations with thin margins and small teams, the compliance burden can consume more resources than the business can absorb. Some smaller dealers are stepping away from the business entirely. Others are restructuring, moving to appointment-based models, narrowing their product focus, reducing transaction volume. The market consequence is consolidation. Business moves toward larger, compliant dealers, which means more of the silver transaction data landscape flows through entities that are fully integrated into the reporting infrastructure. The net effect on your privacy is straightforward: less of it. Let's make this concrete with real numbers, so the impact is tangible rather than abstract. At approximately $75 per ounce, the price point used throughout this analysis, $3,000 represents about 40 ounces of silver. To put that in familiar product terms, American Silver Eagles would represent roughly 32 to 35 coins at current premiums. Canadian Maple Leafs would run approximately 35 to 38 coins. Generic silver rounds put you at 38 to 42 ounces.
3 standard 10-ounce bars get you exactly to the threshold. A 100-ounce silver bar alone, purchased in cash, would exceed the reporting trigger by a significant margin. If you're building your stack with modest, consistent purchases, $50 or $100 at a time, you may move through your buying cycles without touching the CTR threshold on individual transactions. But if you're making meaningful quarterly additions, end-of-year lump purchases, or responding to a price dip with a larger buy, the new threshold captures a very wide range of ordinary investor behavior. Here's how fast a footprint develops under the new framework. Consider a silver investor who's been accumulating for 5 years, putting $500 a month into the stack. That's $30,000 total over that window. Under the regulatory environment that existed before this rule, purchasing activity of that scale might have generated minimal official records, depending on transaction size and method. Under the new framework, a single purchase of $3,000 or more creates a federal record entry. A pattern of such purchases creates a visible accumulation history. And if that investor reaches a point where they liquidate at a profit during a silver rally, both sides of the transaction, the buying and the selling, potentially carry paper trails that exist in federal systems simultaneously. When both sides of your trade are visible, the only person who benefits from your privacy being gone is the government. Now we need to address the selling side, because a lot of people focus entirely on purchase reporting and walk directly into the part they didn't anticipate.
Existing IRS rules already required precious metals dealers to file Form 1099-B for certain sales, specific product types, specific quantities, specific thresholds. The new rule doesn't wholesale replace those 1099-B triggers, but it runs a parallel track. If you sell $3,000 or more of silver for cash, the dealer may be required to file a currency transaction report on that sale, even if the product or quantity doesn't independently trigger a 1099-B filing. The government now has a mechanism to potentially observe both ends of your metals activity, accumulation and liquidation, through different but simultaneous reporting channels. The gain between those 2 points becomes much easier for a revenue agency to calculate, compare, and question. The tax math is not hypothetical. Using the numbers embedded in this analysis, if you purchased silver at $25 per ounce and sell at $75, you've generated a $50 per ounce gain. On 100 ounces, that's a $5,000 taxable event. Federal collectibles tax rates can reach 28% on that gain, plus applicable state taxes on top. If your filings don't reflect that accurately, and the new reporting infrastructure has captured evidence of the transaction, the exposure is real and legally serious. What comes after February 15th? Is this rule a one-time adjustment, or is it the first step in a longer trajectory? Regulatory frameworks almost never stop at their initial specification. They pilot, they establish infrastructure, and then they expand based on what the infrastructure enables. This rule explicitly preserves the authority for future amendments, threshold adjustments, category expansions, exemption reductions. And those changes can happen administratively, without the kind of visible public legislative process that generates headlines and organized opposition. Based on the direction of regulatory movement in this space, here is a realistic assessment of what the next 2 to 5 years may bring. The $3,000 threshold is likely to move lower as reporting infrastructure matures
and political support for precious metals privacy remains limited. Exemptions and categories that currently sit outside reporting requirements become political targets once they're identified as gaps. Peer-to-peer private sale transactions, while not currently captured by dealer reporting obligations, face increasing pressure as regulators seek to close what they characterize as loopholes. And in the most extreme scenario, not imminent but not implausible, disclosure of existing holdings becomes a discussable policy option in a fiscal crisis context once the database infrastructure required to act on that information already exists. I am not predicting these things as certainties. I am describing the logical sequence of regulatory progression based on documented patterns in financial oversight. Each step makes the next step technically possible, politically easier, and administratively faster. The United States is not operating in isolation on this. The global pattern points in a single direction. In jurisdiction after jurisdiction, anti-money laundering frameworks have driven lower cash transaction thresholds, stricter identification requirements, and reduced privacy for precious metals transactions. The rationale is consistent across borders. Governments want visibility into value flows, especially when those flows move through assets that sit outside the traditional banking system. When a global regulatory current runs this clearly in one direction, expecting the United States to diverge over the long term requires a compelling counterargument. That argument does not currently exist in any meaningful policy arena. Let's talk about the real motivation underneath the official justification, because it deserves clear-eyed examination. The stated rationale for this rule, and rules like it, is anti-money laundering compliance and tax integrity. And those concerns are real. Precious metals have been used, at the margins, in financial concealment. Documented cases of AML violations involving physical metals exist and provide legitimate regulatory justification. But the scale and structure of this response, the threshold levels, the data collection scope, the integration into federal surveillance infrastructure, raises a proportionality question worth asking. Physical silver and gold represent something the financial system cannot easily manage, value that exists outside the banking network, an asset class that can't be inflated through monetary policy, wealth that is not subject to account freezes, wire transfer delays, or digital surveillance without significant effort. When a household holds silver, they are making a quiet statement. They don't fully trust the dollar to hold its value. They want a portion of their financial life that operates independently. They prefer some degree of economic privacy. The regulatory architecture now being constructed is specifically
calibrated to reduce that independence and visibility. Whether that's the explicit goal or simply the unavoidable byproduct of AML enforcement priorities is a matter of interpretation. The effect on your privacy is the same either way. To be absolutely clear, nothing in this analysis is an encouragement toward illegal behavior of any kind. Tax obligations on silver gains are real and legally enforceable, independent of any reporting changes. What we're examining here is the direction of travel, the arc of regulatory encroachment, and what it means for people making lawful financial decisions about how to hold wealth. So, what do you actually do? What are the specific,
actionable legal steps that protect your position between now and February 15th and after. First, calibrate your awareness of the timeline. Dealer compliance behavior changes on February 15th. Some dealers are tightening identity verification policies effective that date or earlier. Understanding the shift isn't a call to break any rule. It's recognizing that the compliance environment is actively changing, and your interaction with dealers will reflect that change in real time going forward. Second, maintain and strengthen relationships with local coin shops while that market segment still exists in meaningful numbers. Some smaller operations will not survive the compliance burden of this new rule. The ones that adapt and continue operating may offer more flexibility and better service for buyers with normal transaction profiles. But expect verification requirements to increase across every type of dealer, large and small. Third, understand the structuring risk deeply and be deliberate about your purchasing patterns. If your natural buying habit involves smaller, consistent purchases, that pattern is unlikely to raise flags on its own. What creates federal scrutiny is behavior that appears deliberately calibrated to stay under a reporting threshold. Multiple purchases in close temporal proximity, incremental amounts that sum near the limit. The safest position is consistency and documentation. Never design a purchase pattern to evade a threshold. The appearance of that design is the legal exposure, regardless of intent. Fourth, develop a clear picture of how your specific product choices are treated under the current reporting framework. Dealers may categorize different products differently for reporting purposes. Know what you're buying. Ask your dealer directly how they handle reporting on the products you're purchasing. Request that their policies be provided to you in writing where possible. That documentation protects you. Fifth, build a meticulous personal record system covering every transaction. Receipts, invoices, dates of purchase, quantities, per unit costs, premiums paid, storage details. This is not bureaucratic overkill. It is the documentation that protects you from overpaying taxes, that answers questions if your records are ever requested, and that provides the cost basis information you'll need when you eventually sell. Treat your silver holdings like a business, because from the government's perspective, they now are. Sixth, work with a tax professional who has specific experience with precious metals. The intersection of collectibles taxation, reporting requirements, and individual financial circumstances is not a place to navigate with generalist advice or forum opinions. If your holdings are meaningful in dollar terms, the cost of a qualified CPA or tax attorney consultation is a small fraction of the exposure you might face without that guidance.
Thanks for watching my video. Please subscribe my YouTube channel.